Hello and welcome to the ENT 640 Entrepreneurial Funding Screencasting video. This is the team of Jeremy Balog, Arlene Childers, and Jose Figueroa. Today we're going to talk about the income statement, which is an important financial document when you're creating a business plan. The income statement is just one of several financial documents that come together to make the full picture of the finances for a business. But today we will talk about the income statement. First, let's define what the income statement is. The income statement itemizes the revenue and expenses of a business to determine the financial performance of the business. It shows how much the business has earned or lost over a period of time. It portrays a video of the business's activity. There are a couple of names for an income statement, sometimes called the profit or loss statement or the P&L. The income statement shows how much money the business will make after all the expenses are accounted for. And is determined by subtracting the cost of goods and expenses from the revenue, and the net result is either a profit or a loss for that business. Excuse me. Usually in an income statement, there's from 1 to 3 years worth of data. So I'm going to talk just a little bit about the information that goes into the income statement. The net sales are made up of months 1 through 12, and then usually a year in total. The monthly product sales, or the number of units sold, times the price per unit. So you take how many units are sold, and then the price of each unit to determine the net sales for each month. Then you subtract the cost of goods sold, which is comprised of materials and labor. The materials is calculated by the cost per unit produced times the number of units manufactured. So then you take the labor. The labor is determined by the cost of the labor per unit times the number of units manufactured. So you have to know how many units you're manufacturing, and then you have to know the cost per unit of the materials and the labor. Then you take and calculate the total materials and labor cost, and that gives you the total cost of goods sold. The gross margin is made up of the net sales plus the cost of goods sold. And then you calculate your gross margin percent. To calculate that, you take the gross margin that you just calculated divided by the net sales. So both those values come from up above. Excuse me. Gross margin divided by net sales. Next, we think about operating expenses. Operating expenses are expenses that are not dependent on the production or the sales level, but they are important expenses that are calculated. They're fixed cost, and they are calculated each month. Examples of that would be rent, salaries of the owner and employees, and then marketing. Whatever amount that you're budgeting for marketing would be an operating expense. Then you add all of the total and calculate total operating expenses for each month, and then for the yearly total. You also have to think about the cost of equipment and calculate the equipment cost amount. The net operating income is calculated by net sales plus the total cost of goods sold plus total operating expenses plus the cost of the equipment. The interest on the cash is, for our example, is 3%, and is calculated by the net operating income plus the interest on cash. We also have pre-tax earnings, which are the net operating income plus the interest on the cash and the depreciation amount. Net taxable income is pre-tax earnings plus the depreciation for the items. The provision for taxes comes from the net taxable income times the corporate tax rate. And then the net income, which will be a profit or a loss, is calculated from the net taxable income minus the provision for taxes. So as you can see, there's lots of information that comes from various places. Different tables are involved that you use to get some of the information that you need. So, excuse me, income statement financial projections. Let's go over a couple of these. Income is all the income generated by the business from the sales of products or services. The cost of goods is going to be all the costs related to the sale of products in the inventory. Gross profit margin, some of this I mentioned in the little chart earlier, the difference between the revenue and the cost of goods. Operating expenses are all overhead and labor expenses associated with the operations of the business that cannot be linked directly to the production of the products or services. So operating expenses are not directly related to the production of the items or the products you're selling. Total expenses is the sum of the cost of goods sold plus the operating expenses. Net profit is the difference between the gross margin and the expenses. Depreciation reflects the decrease in value of the capital. Companies depreciate the assets over a period of time as they're used. Earnings before interest and taxes depict the capacity of the business to repay its obligations. The interest includes all short-term or long-term interest payable from debts. And then taxes are, all businesses have taxes, and all taxes on the business are included in that line. Net profits after taxes shows the company's bottom line, or how much the business actually earned or lost during the accounting period. This is an example of an income statement completed and how it might look. It shows lots of numbers and lots of calculations. When you're putting this into a spreadsheet or a pro forma, you should make sure that your formulas and functions and your calculations are correct, because they do carry over several sheets, the data, so it's important to make sure the calculations are correct. The income statement, also called the profit and loss statement or the report of earnings sometimes, tells the business owner or the investors the income in business, what the income the business has earned in the accounting period, the cost or expenses that are incurred by the business during the period, the difference between the cost and income or net profit or loss for that period. And normally 3 years worth of income statement data is presented so that the business owner can make data comparison and identify trends. It's important to look at the data over time and make sure you are comparing. As you look at all these financial documents together, the more you understand where the information comes from and how it works together, then the better, more informed business decisions you will be able to make. For businesses to have stock options, most income statements report earnings per share or EPS. The EPS calculation tells you how much money the shareholders would receive for each share of stock they own if the business distributed all of its net income for that period. In order to calculate earnings per share, take the total net income and divide by the total of outstanding shares of the business. The balance sheet is a financial statement giving a snapshot of the business at a position in a point in time. It shows you what the business owns, its assets, and what it owes, its liabilities and equity. Assets are everything of value. Liability and equity on the balance sheet represent the business's source of funds. The income statement is based on the accounting equation income equals revenue minus expenses. The balance sheet as a financial document is based on the fundamental accounting equation assets equals liability plus owner's equity. The income statement shows the business owner what happened during the period between balance sheets. If the business has a loan, the interest and bank charges are recorded on the income statement. The bank loan payable is recorded on the balance sheet. The income statement and balance sheet, along with the cash flow, form the basic set of financial information required to manage the business. And the financial documents together must be used to determine the health of the business. Thank you very much. We appreciate your time and hope that you have learned some things that maybe will help you in your business. And thanks very much.